Well, welcome back. As the TSX slides yet again today, our next guest is maintaining 20% cash in her portfolio and says it will get higher if the market continues to erode. Let's bring back in Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, thanks for doing double duty with us today. It just seems like there's so much to talk about. So 20% cash in your portfolio. Can you give us some context as to how high that is, in comparison to other times?
Well, it's not as high as it was in 2008, but it's pretty high.
Well, there's that. Yep.
Yeah, it was higher than 50% at the time, and
Wow.
At that time we moved into corporate bonds and investment grade and high yield bonds. Spreads were so wide, so we'll go where the strength is, and we'll exit where it isn't. And we're very disciplined sellers. And if I was to give traders or investors one bit of advice, it's easier to buy than it is to sell. It's very hard to sell. And so if you have a selling discipline, whether it's a stop loss or a level or a strategy on how to exit things, you should stick to it with big discipline, because the psychology is very hard. So we're very, very disciplined that way. And that's why we have 20% cash. As the market deteriorates and the stocks that we own perhaps deteriorate, from a relative strength perspective is what our strategy is. We will exit even if we think or loved it 3 months ago. You can always buy it back, but from a risk management perspective, this is how we get to our cash.
I wonder what you're thinking about bonds lately, because we've seen this bond sell-off happening and yield surging. Is this an area that's interesting you right now?
So we are not bond. Well, we do have some bond mandates, clients that want to be on bonds and that sort of thing. And actually, it's a double-edged sword, because there's some really good yields to be had here in certain corporate bonds and investment grade. And even, the U.S. Treasury 10-year pays you, 4.8 right now. So there are some attractive yields. But if rates continue to move higher, the actual pricing mark to market is going to go lower. One of the things that are challenging in this market is that the spread between the bond yield and the equity yield is too wide. And so one of two things has to happen. Either bond yields come down, or equity markets sell off in order to increase their yield to be more attractive relative to bonds. And one of these is going to happen, or both at the same time. From a bond perspective, there's always bond buyers out there, large pension funds that need to lock in and are able to lock in certain rates that make them better funded. Again, it's not about the trade, it's about the yield you lock in. And if you're okay with holding on to that bond to maturity at a 5% yield or 6% or 7% from a corporate perspective, that's not bad.
Diana, we were talking about energy. I wonder if you could just give us really quickly a couple of names that you think have potential right now.
Yeah, so we're keeping the names in our portfolios large cap and liquid with great balance sheets and paying down debt. So some of our names are in the Canadian side would be Imperial Oil, CNQ, and Tourmaline. In the U.S., we have ExxonMobil and Hess. You will note that those are all very large cap companies. They all pay some sort of dividend. They are all growing their dividends. They're all paying down debt, and they don't need to come to market in order to finance themselves, which is a big deal in this market. It's okay to buy bonds that yield you 5 and 7% and hold them to maturity, and not pay attention to the mark to market if you're going to be off a little bit. But it's another thing for companies that need to come to the market to gain access to funds. It'll be very expensive capital costs.
Diana.